Welcome to IFRS 20 Masterclass, that is Regulated Assets and Liabilities. If you are an auditor or an accountant or an investor are working in a rate-regulated industry or in a rate-regulated company, it will interest you to know that the International Accounting Standard Board, IASB, on the 27th of May 2026, released a new IFRS standard, that is IFRS 20. So in this class, I'm going to explain clearly what IFRS 20 is all about. We're going to learn how to recognize a regulated asset and a regulated liability. So we're going to learn the recognition criteria for IFRS 20. We're also going to learn how to measure the regulated assets and regulated liabilities under IFRS 20. Also, we're going to learn how to present it in the financial statements. We're also going to learn what the disclosure requirements are. So this class promises to be very interesting. I want you to be among the first people to be knowledgeable about this new standard. The standard basically replaces IFRS 14, which is regulatory deferral accounts. It does not replace IFRS 15, revenue from contract with customers. Rather, it supplements IFRS 15. So I urge you to watch this video to the end so that you can learn and have a rock-solid knowledge of IFRS 20, which is a brand new standard. Now, IFRS 20, as I said, was issued on 27 May 2026 for companies that are subject to a specific type of rate regulation. And it's going to come into effect fully on 1st January 2029. In other words, that is when it is going to be mandatory for companies to apply it. But for now, early adoption of this standard is allowed. So if you're a company, if you're an accountant, if you work in this industry, why don't you take advantage of the early adoption of this standard and straighten your financial processes? So let's delve into it. If you're ready, let's go. But before we do, I just want to let you know, companies that supply vital services such as electricity, water, gas, and other utilities are the companies that this standard basically affects. So it's a brand new standard, IFRS 20. Now this standard replaces IFRS 14 and introduces a comprehensive accounting model. In the past, we have different ways of handling issues in this sector, but now there is a single model that IFRS 20 brings to the table. So it becomes effective on 1st January 2029, though, as I said, early adoption is permitted. Let's look at what the problem was before the creation of this standard. Before IFRS 20, IFRS accounting standards did not contain a complete model for accounting for rate-regulated activities. So companies in rate-regulated activities, like, carrying out electricity services, utilities, water, gas, and others, there was no single standard to regulate them. So because of this, comparability was a problem. I mean, if you wanted to compare one company in the electricity industry with another company, because they were not using a single model, comparing them was difficult. Similar companies reported differently. Investors struggled to compare utilities, and then revenue often failed to reflect economic performance. Now, economic performance is reported by the statement of profit or loss and other comprehensive income. So, because there was no single model, different companies, when you compared them, you couldn't get it. So it was not easy for the economic performance to be well reflected. This is because a company could earn revenue in line with IFRS 15, revenue from contract with customers. But to collect the money, there would be a regulation that would prevent them from actually recording their revenue in that period. So these posed a serious problem, and it became a big problem for reflecting correctly the economic performance of that company. So there's a gap in financial reporting caused by a lack of information about differences in timing. What do I mean by differences in timing? Now, a company could supply services of, let's say, 100 million to customers, but to collect that revenue in that period, the regulator may say, okay, you can only collect 70% of it. You are not permitted to collect it. You can only collect the balance in the next year, or maybe in 2 years from now. Now, this is where regulation comes in. So because of this regulation, there is what we call a gap, a timing difference in when the revenue is earned in line with IFRS 15 and when the payment is made. So because of this, there was a gap. But now IFRS 20 has come in to do justice to this timing difference. So IFRS 15 revenue recognized in a period not equal to compensation to which a company is entitled for regulatory goods or services supplied in that period. Let's go to the next slide. Why was IFRS 20 created in the first place? I've explained part of it already, but it aims to help investors better understand how rate regulation affects a company's financial performance, financial position, and its prospect for future cash flows. So we're saying that it helps investors to understand the three major financial statements, which is for financial performance, we're talking of the income statement. For financial position, we're talking of the balance sheet. And for cash flows, we're talking about the statement of cash flows. So it helps investors to better understand how rate regulation affects the company's performance, their financial position, and their cash flows. Also, another reason why it was created, IFRS 20 requires rate-regulated entities, such as utility providers, to account for discrepancies between service delivery and customer billing. So we call these differences in timing, as I explained before. We have timing differences. The time from when the service is supplied, is delivered. The utility provider delivers his services, but the billing, the charging is not allowed by the regulator to collect for that period. So because of that, we have a timing difference. So this standard aims to improve financial reporting, accuracy, and enhance comparability across regulated industries. So the essence of IFRS 20 is to ensure that all rate-regulated companies can be easily compared and their economic performance will reflect the true nature. So according to the IASB chair, that's the chairman of the International Accounting Standard Board, Dr. Andreas Bacco, he said, and I quote, IFRS 20 will provide investors with more complete and transparent information about companies operating in these critical rate-regulated industries. End of quote. So that is why IFRS 20 was created, to fill that gap that was created by timing differences, and also to ensure that the economic performance is well regulated, and also to ensure that financial position is well reflected, and also to ensure that prospect for future cash flows can be easily analyzed. Okay, so let's see who is affected by IFRS 20. IFRS 20 mainly affects electricity companies, water companies, gas distributors, transportation infrastructure entities, and other businesses whose prices are regulated by a regulator. So in Nigeria, for instance, we have the Nigeria Electricity Regulatory Commission, and we have the NESI, that is the Nigeria Electricity Supply Industry. So we have the GENCOs, we have the DISCOs, we have the transmission. all the players in the Nigeria electricity supply industry. So they are regulated by NERC, that is the Nigeria Electricity Regulatory Commission. So examples include public utility companies whose customer charges are approved by a regulator. So if you operate in this industry, any of these industries, whether it is electricity, whether it is water, whether it is gas, whether it is transportation, as far as there is a regulator that approves your rate, then you're affected by IFRS 20. Let's now look at what rate regulation means. What is rate regulation? Rate regulation, let me explain so with an example. Imagine that a regulator says to you, you may charge customers only 100 naira today, but next year you can recover an additional 20 naira. So what it means is that you are actually earning 120 naira, but you are not permitted to collect 120 naira in this year. You can only collect 100 naira this year. The next year, you collect 20 naira. So what is that 20 naira? That 20 naira that you earn this year but cannot collect this year brings about what we call a timing difference. So the company has already earned 20 naira economically, but cannot recognize it. You cannot recognize it because the regulator does not allow you. IFRS 15, revenue from contract with customers, allows you. It says you have ended in line with accrual concept. You have already ended, but you cannot recognize it. Because of what? Because there's a regulator in between. Because of that, it creates what we call timing difference. What is the central idea of IFRS 20? According to the IASB, IFRS 20 seeks to align income recognized with the total compensation that the entity is entitled to earn for regulatory goods or services supplied during the period. So this is a central idea. The idea is that you want to align the income that you have recognized with the compensation that the entity is entitled to. So you are entitled to collect one in that period, and the other, the regulator says it has to be in the next year or in the subsequent year. So IFRS 20 wants to align them, to align the income that you recognize with what? The total compensation that you're entitled to. So this is what the standard is all about. So IFRS 15 may not tell the whole story, but IFRS 20 adjusts for timing differences. When these three things are involved, what are these three things? One, services have already been supplied. You have delivered your services. Whether it's electricity, whether it is water, whether it is gas, whether it's transportation, you have already delivered. Secondly, the amount that can be billed now. What you supplied is not exactly what can be billed now. There's a difference between what was supplied and what can be billed now. And then that difference is the amount that will be billed later. So these three things is what IFRS 20 seeks to align. IFRS 20 knows that in rate-regulated companies, you supply the services in 1 year. You can only bill for a part of it in this year. And then you can bill for the balance in a subsequent year or in subsequent years. So this timing difference is what IFRS 20 seeks to align. Now let's look at key definitions of IFRS 20. When we understand these key definitions, it will make our understanding of the standard to be better for us. So there's what we call regulatory agreement. What is a regulatory agreement? An agreement is an agreement. So a regulatory agreement is what we're talking about. And it is an arrangement between the regulator and the company. So it's an arrangement that establishes what? Enforceable rights and obligations. The key words here are two: rights and obligations. So it is an arrangement between the company and the regulator. And it is about what? Enforceable rights and obligations. And it determines how regulated rates are set. So there's something we call regulated rates, which we are going to talk about. Regulated rate. There's an agreed rate that you can collect. in the future. A regulatory agreement is an arrangement that establishes enforceable right. So one, enforceable right. The company can enforce that right to collect from the customer. And there's also an enforceable obligation where the agreement forces the company to give services for money already collected. So there are two things. So one is an asset and the other is a liability. So there's a right and there's an obligation, and both of them are enforceable. So the regulatory agreement takes charge of all of this and also states the regulated rate. There is always a regulated rate. Good. Now, what is a regulatory asset? Having known what a regulatory agreement is, let's move to regulatory asset. A regulatory asset is an enforceable present right. We know what an asset is. We say an asset, generally an asset, is a present resource controlled by the entity as a result of a past event from which future economic benefits are expected to flow to that entity. So to relate it to a regulatory asset, what do we say? We say it is an enforceable present right. You see it? Enforceable, but it is present and it's a right to increase future customer rates. So in the future, you're going to increase the rate because you already delivered this year, but you cannot collect because there's a regulator not permitting you to collect. So a regulatory asset is an enforceable present right. The right is present, even though you are going to collect in the future, but it is a present right. And if, of course, it's as a result of a past event, and it's to increase future customer rates in the future. So think it like this. We supplied services today, but we will recover part of the compensation later. So that makes it a regulatory asset. I think that is clear enough. Let's move to regulatory liability. Now, this is the mirror opposite of the regulatory asset. The regulatory liability is the mirror opposite of the regulatory asset. Just like asset and liabilities as explained in the IASB framework. So if you understand that, anywhere you see asset, whatever is attached to it, you have to understand it in that line. So a regulatory liability is an enforceable present obligation. You see, I say it's a mirror opposite. So one is a right to collect in the future. One is an obligation to deliver in the future. So it's an enforceable present obligation to reduce future customer rates. Here you are going to deliver. You are going to reduce the customer rate, not to increase. So for the right, you are to increase future rate. For obligation, you have to reduce rate in the future. So this is what it means. And think of it like this. We collected compensation today for services that will be delivered later. Okay, let's move on to look at recognition criteria. How do you recognize? What should you recognize? So what are the recognition criteria? A regulatory asset or regulatory liability exists or is more likely than not to exist. Then you recognize. So if it exists or is more likely than not, what do we mean by more likely than not? It means it has a higher probability of existing. Then you recognize that regulatory asset or that regulatory liability. Now, recognition of some regulatory assets and regulatory liabilities is subject to specified conditions. Some of them have conditions that must be met. Let's look at these conditions. The conditions, we say an entity can only recognize a regulatory asset or regulatory liability if both of the following criteria are met. So both of these conditions must be met. The number one is that a binding regulatory agreement exists. The entity and an authorized rate regulator, that's the regulator of the industry. I made an example of Nigeria Electricity Regulatory Commission regulating the electricity sector in Nigeria. So the entity and an authorized rate regulator must be formal parties to a regulatory agreement. So there must be a regulatory agreement, and both the company and the regulator must be parties to it. So these agreements must legally prescribe the specific regulated rate. So this rate must be agreed. This regulated rate is calculated, is to compensate for asset, for instance, is to compensate the company for waiting, for not collecting his money in that year, but to collect it in the future date. So it is usually calculated like the weighted average cost of capital, because of the time value of money, you have to discount it. So that entity is permitted to charge its customers for goods and services. So I said this agreement must legally prescribe the specific regulated rate that the entity is permitted to charge its customers for goods or services. So that is condition number 1 in the recognition of some regulatory assets or regulatory liability. Number 2, there has to be a difference in timing. If not, it's not possible. What do we mean by difference in timing? A strict timing mismatch must occur. So if everything you supply the customer is everything you collected as your income this year, then there's no timing difference. But when what you earned based on your supply of utilities is not exactly what you collected, because the regulator says you can only charge a part of it, then it means one part of what you have earned in this year has gone to another year. So there is what we call a timing difference in this area. So a strict timing mismatch must occur. This means all or part of the total allowed compensation for goods or services supplied by the entity in the current reporting period will be charged or credited to customers through regulated rate in a different period. Look at this, underline this. So in a different period, that's past or future. So that is the mismatch. So these are the 2 conditions that must occur for you to recognize a regulatory asset or a regulatory liability. Well, let's look at a simple example of a regulatory asset. A power company supplies electricity in 2026. The regulator determines 1, allowed compensation is 120 million naira. But it says, the regulator says, customers can currently be charged only 100 million naira. You see that? So the company has delivered 120 million naira worth of services, but the regulator says you can only charge 100 million out of 120 million. This is usually because some of these services are essential. There is subsidy from government. There is some form of regulation of the rate, because government has to create a good environment for the citizens. So because of that, the regulation perhaps helps to cushion the effects on the customers. So government or the regulator says you can only charge 100 million. So what happens? Under IFRS 15, your revenue is 120, and using the accrual basis, you have to recognize 120. But in this rate-regulated environment, 120 million naira has been earned, but the regulator says you can only charge 100 million. The balance of 20 million will be in a different period. So what does that mean? It means there's a difference of 20 million naira. So the company has already earned this amount economically, but will recover it through future rates. And this results in what? A 20 million naira regulatory asset. So that 20 million naira becomes a regulatory asset. And there has to be a regulatory rate agreed between the regulator and the company. And of course, to recognize it, you have to discount it to present value. We'll talk about that much later. So this example about a regulatory asset, I hope it is clear. And let's look at another example to explain what a regulatory liability is. So suppose customers are charged 130 million naira today. However, allowed compensation for current service is only 100 million naira. So there's an excess of 30 million that relates to future services. So the company is going to offer services in the future. This time around, the company is not going to collect. The company is going to offer services. So there's a present obligation to offer services in the future. So because of that, the company has to recognize a regulated liability. Good. Now, the recognition principle is simple. IFRS 20 generally requires recognition of a regulatory asset and regulatory liability that exists at the reporting date. So you have, at the reporting date, you have to recognize once the conditions are met. So generally, companies are required to recognize regulatory assets and regulatory liabilities that exist at the reporting date. So at the reporting date, you have to check, is there a regulatory asset? Can you recognize it? Is there a regulatory liability? Can you identify it? It has to be recognized. So where uncertainty exists, then that is where we come to what we say more likely than not. More likely than not. And I say more likely than not means there's a higher probability that the regulatory asset or liability does exist. So recognition is based on whether it is more likely than not that the asset or liability exists. Measurement. How are regulatory assets and regulatory liabilities measured? How? IFRS 20 uses a cash flow based measurement technique. It's a cash flow based measurement. So you look at cash inflows and cash outflows. So the entity estimates the future cash flows arising from the regulatory asset or regulatory liability, and then it discounts it using that rate, the rate that is agreed between the company and the regulator, which we call the regulatory interest rate. So that is what a regulatory interest rate means. And I told you it follows the same pattern for arriving at rates. So usually it is the weighted average cost of capital. So many factors will be taken in, but however it is done, it is to make sure that the company is compensated for that period that is waiting. So this, you discount it because of the time value of money. Okay, now let's look at regulatory interest rates. A unique feature of IFRS 20 is the use of the regulatory interest rate, which I explained before. And this rate is used to discount expected future cash flows. The same regulatory interest rate continues to be used subsequently. So you begin, even in subsequent years, you use the same regulatory interest rate. So you use it to discount. Good. And unless the regulatory agreement changes that rate. So if there's a fresh regulatory agreement that changes the rate, then that new rate that is agreed upon will now supersede. But if not, the old regulatory rate will be applied in subsequent years. So note that the regulatory interest rate or regulatory return rate is obtained directly from the regulatory agreement. As I said before, it is stated in that regulatory agreement. It is the rate specified by the regulator to compensate an entity for the time lag until a regulatory asset is recovered. So I explained that before. Or to charge the entity for the time lag until the regulatory liability is fulfilled. So there has to be some form of compensation. I mean, you earned your revenue this year. You supplied the service, but the regulator says you cannot charge fully for it. So until next year or 2 years later. So for the period that you're waiting, there has to be some form of compensation. So that rate will factor in your waiting period to compensate you because of that lag, that time lag that you're waiting. So that is the regulatory interest rate, otherwise called the regulatory return rate. Now let's look at subsequent measurement, which I explained in a little. After initial recognition, you have to update expected future cash flows because it has to be updated. You know, payments are made, so you have to be doing your reconciliation to update it. And also you have to recalculate the carrying amount. If it was an amount before, now payment has been made from it, there will be a balance. It won't be the same. So it is reducing or increasing depending on whether it is a regulatory asset or a regulatory liability. So you have to recalculate the carrying amount of that revenue. Okay? So then you have to continue discounting using the regulatory interest rate unless there's a new agreement. So this ensures measurements remain constant. Derecognition, removing from the books. A regulatory asset or liability is removed when it no longer meets the definition of a regulatory asset or liability. This is clear to every accountant. So once it does not meet the definition, the recognition criteria for a regulatory asset or liability as explained before, then you have to remove it from the books. It is no longer a regulatory asset. Then you don't need to classify it as a regulatory asset, or it's no longer a regulatory liability. You cannot continue to call it that. So in practice, this is the process. The recovery right disappears, obligation disappears. See, the right is the regulatory asset. The obligation is a regulatory liability. So this disappears, and then the amount is settled through future rates. After that is done, derecognition occurs. Now let's look at regulatory income and regulatory expense. This is treated in the income statement, not in the balance sheet. The regulatory asset and regulatory liabilities are in the balance sheet. Now let's look at regulatory income and regulatory expense in the income statement. This affects performance. So a completely new concept was introduced by IFRS 20. One is regulatory income. What is it? The income arising from initial recognition or subsequent upward measurement of a regulatory asset, or the reversal or decrease of a regulatory liability. So look at what it means. A regulatory income is any income that arises from initial recognition, at initial measurement. You are having an income, or maybe there's a subsequent measurement of a regulatory asset and you have income. That income is a regulatory income. Or if there is a reversal of regulatory liability, then there is a regulatory income. As you are reversing the liability, you are having a regulatory income. Also, this is the opposite, expense. The regulatory expense. The expense arising from the initial recognition of subsequent increase of a regulatory liability. So once there's an expense related to increase of a regulatory liability, then you have a regulatory expense. It means it is not an asset but an expense, because it is an expense in nature. By nature of how it happened, whatever expense you incur in establishing that regulatory liability, or the reversal or decrease of a regulatory asset. So when you reverse, decrease a regulatory asset and you incur any expense, that expense is called a regulatory expense. Now, these are presented separately to help users understand the effect of rate regulation. So I'm going to drop some practical examples of a regulatory income and a regulatory expense to make them clearer. Now let's look at presentation under IFRS 20. So we have presentation in the statement of financial position, and we also have in the statement of profit or loss and other comprehensive income. So under the statement of financial position, that's the balance sheet, we have regulatory assets and regulatory liabilities reflecting. You know where all assets will be. So the regulatory assets will find its way to where assets are. And of course, the regulatory liabilities will find its way to where the liability side. You know, the balance sheet follows the accounting equation format. All assets are equal to liabilities and equity. So they'll find themselves in the statement of financial position, otherwise called the balance sheet. Now, for statement of profit or loss, we know that expenses are charged in the POL, and also income also go to the income statement. So the regulatory income will go to the profit or loss, and the regulatory expense will also go to where the expenses are. So this is how it is done. So this provides transparency regarding regulatory effect. So the effect of whatever has happened in this rate regulated industry with respect to regulatory assets and regulatory liabilities will bring about regulatory assets, regulatory liabilities going to the balance sheet, and then regulatory income and regulatory expense going to the income statement. Now let's look at disclosure requirement. What are you mandated by IFRS 20 to disclose to the users of the accounts? Entities must provide information enabling users to understand regulatory assets, regulatory liabilities, regulatory income, regulatory expense, and effect of future cash flows. So you must disclose this. We want to know how regulatory assets, liabilities, regulatory income, expenses are affected by your transactions. We also want to see the effect that it has on your future cash flows, because the essence of preparing accounting statement, financial statement is to help users make the best decisions. So this will bring about transparency and help users of the accounts, help users of the financial information to take the best decision. And it will be very transparent, and it will bring about comparability. You can now compare companies in the industry better than before. So the objective is to help investors assess financial performance and future prospects. You see, this is decision making. Now, the following must also be disclosed: reconciliations, maturity analysis, unrecognized regulatory assets, and unrecognized regulatory liabilities. Let's take them one after the other. Under reconciliations, entities must provide a detailed roll forward reconciliation. So you have to provide a roll forward reconciliation from the opening balance to the closing balance. So for us to know both regulatory assets and regulatory liabilities. So the reconciliation roll forward must be done so that we can see it clearly from the opening to the closing. Maturity analysis, we want to know how old is this regulatory asset or regulatory liability that you have. So maturity analysis will say entities must disclose a breakdown of when they expect to recover regulatory assets and settle regulatory liabilities. Is it 1 year? Is it 2 years? We want to know. You have to disclose it. That's what the standard says. IFRS 20 says so. Another one is unrecognized regulatory asset and unrecognized regulatory liabilities. If a regulatory item does not meet the strict probability, we say you recognize when it exists or when it is highly probable that it exists. So where it does not meet that criteria for the recognition, what do? You have to disclose. So if a regulatory item does not meet the strict probability or measurement threshold for balance sheet recognition, it must be disclosed in the footnote, that is in the notes to the account, if it is material. You know what materiality is. If you've not watched my video on materiality, go and watch it. But materiality simply says it has the ability to influence the decision of the user of that financial information. So if an information or a piece of information has the ability to sway the user to this right or left, to say yes or no, to change your mind, your decision, then it is material. So let's move on. Let's look at, we said it replaced IFRS 14. What is IFRS 14? IFRS 14 is regulatory deferral account. So IFRS 20 replaces it. So let's look at it. We're going to juxtapose IFRS 14 with IFRS 20. Now, IFRS 14 was an interim standard. IFRS 20 is more permanent in nature. It is comprehensive. It's a comprehensive standard. That's the first difference. The second difference, IFRS 14 is limited. It has a limited application. It does not cover the rate-regulated industry as a whole. It is limited. Now, IFRS 20 is broader, is wider. So it's a wider accounting model. Okay? IFRS 14 allowed continuation of previous generally accepted accounting principles, policies. It allows it. IFRS 20 says, well, let's introduce a new accounting model. So there's a new accounting model to follow. So we have the regulatory assets, we have the regulatory liabilities, we have the regulatory income, we have the regulatory expense. So it introduces a new accounting model. Then IFRS 14 offered a temporary solution. IFRS 20 offers a permanent solution. Now let's look at some possible exams or interview areas. If you're going to write ICANN or ACCA, CPA, CMA, any of these accounting, professional accounting examinations, or you are going for an accounting interview, you may receive some of these questions. So let's look at one or two traps that the examiner or interviewer can set for you. So trap number one, thinking IFRS 20 changes IFRS 15 revenue. That is what some people think. Don't ever think that IFRS 20 came to replace or to change IFRS 15. IFRS 15 is revenue from contract with customers. It does not replace it. No, it only supplements it. So if you think so, you are wrong. IFRS 15 still applies. IFRS 20 adds information about timing differences. It strengthens IFRS 15 because it talks about timing differences. Because IFRS 15 does not tell us the full story. There's timing differences. So IFRS 20 handles timing differences. So it supplements, it adds information to IFRS 15. So don't ever think that it came to replace IFRS 15 on revenue from contracted customers. No. Next trap, confusing regulatory assets with trade receivables. No. Trade receivables are not the same. Trade receivables are debtors. You sold on credit to your customers and they have not paid you. So you are going to collect. Some may not even pay. Yes. And you write them off as bad debt. But for regulatory asset, a regulatory asset is a right to increase future regulated rates. You see the difference? It's a right to increase future regulated rates. So it is different from trade receivables. So it's not merely a customer receivable. No, it is a right to increase future regulated rates. So don't mix it up. Trap number 3, ignoring the regulatory interest rate. Remember, I told you that the regulatory interest rate is the rate that compensates the company for the time lag from when the service was supplied to when compensation is fully received. So, never, and it's also agreed and stated in the regulatory agreement between the regulator and the company offering the services. So, never ignore the regulatory interest rate. This rate is very important. It's a key measurement requirement under IFRS 20, and it is what is used to discount. If you want to know, because of time value of money, you want to make initial recognition, you have to discount to present value. So what do you use to discount to present value? You have to use that rate. And why do you have to discount? You have to discount because 1 naira today is worth more than 1 naira tomorrow. Time value of money. Because of what? Inflation. Because of uncertainty. Because of risk. Maybe some other factors. Now, let's look at this multi-choice question to test your understanding of IFRS 20. A utility company earns compensation today, but can recover part of it only through future regulated rates. Look at the question again and think. A utility company earns compensation today. You have earned your compensation. You have supplied services, earned your compensation in line with accrual basis. Even though maybe you've not been paid, but you've earned it. Because we say accrual says recognizing revenue and cost incurred in the period in which they are earned or incurred, not in the period when cash is paid or received. That is the accrual basis, which is different from the cash basis. So we're saying a utility company earns compensation today, but can recover part of it only through future regulated rates. There's a regulator that says you can recover part of it only. You can only recover part now, but the other part is only through future regulated rates that you can recover it. So what should be recognized? Is it trade receivable? B, deferred revenue. C, regulatory asset. D, provision. Do you have the correct answer? Score yourself. Did you get it? Correct answer is regulatory asset. So if you got this correctly, it means that you're doing very well. In summary, I want to say these 5 points should always be remembered. Always remember them. When you think IFRS 20, think of these 5 points. 1, IFRS 20 was issued on 27 May 2026. That's when it was issued. And it replaces IFRS 14. What is IFRS 14? IFRS 14 is regulatory deferral accounts. It replaces it. It was temporary. It applies to certain rate-regulated entities, and it introduces regulatory assets, regulatory liabilities, regulatory income, and regulatory expense. So it becomes effective on 1st January 2029. So IFRS 20 will become effective on 1st January 2029. But early application is permitted. Early adoption is permitted. So tell me, I want to know, will you want to adopt it in your company right now, or are you going to wait for 1st January 2029 when it becomes mandatory? In conclusion, I want to say we've covered a lot of ground today, from the core principles of IFRS 20 to the practical application of those regulated assets and liabilities on your balance sheet. This standard is going to be a major talking point in 2026 and beyond. So I hope this deep dive gives you the confidence to apply it correctly. If you found this masterclass helpful, hit that like button like you mean it. It really helps this educational content to reach more people who need it. Do you have a specific scenario in your industry where IFRS 20 feels tricky? Drop it in the comments below and let's discuss it. Don't forget to subscribe to Finance Simplifier for more deep dives into the world of IFRS. I'll see you in the next lesson. I'm Echela Okori. Thanks for watching.